down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
Ladies and gentlemen, yep, boys and somebody, I'm on the radio with Jeff Holst. Yes, international fame and fortune playboy from Detroit, Michigan / Chattanooga, my favorite city besides Oklahoma City. And today we are talking about multifamily units, and that's something over 4 units or above. Usually you cannot get residential lending. Actually, you can't get. I just saw a deal go bust just recently that it was a 10 fourplexes, and the FHA would not loan on those. They'd have to go commercial. So that's how you distinguish between commercial, even though it was 10 separate structures for this loan. So multifamily. Jeff, how did you get into multifamily, and why, and what do we look for? And give us an insight on your take on multifamily.
Sure. So the first part of the question is, how did I get into it? And the simple answer is I found an apartment complex I liked and I bought it. But, that's sort of facetious, I suppose. But no, listen, so the reason I got into multifamily is because I think that when you get to the commercial deals, the 5 units and up that you're talking about, you have a lot more control over the value, because if you increase the net operating income, you sort of automatically increase the equity position, because the valuation of those properties is really based on an income approach. So if you can lower the expenses or raise the rents, or do both ideally, then you get to generate a lot of equity that you can later tap into either through sale or refinance. And that's the real reason I wanted to get into them. We had a number of single families and small multis like duplexes and things like that before we started buying. And the first one we bought actually was kind of similar to the example you were just talking about. It was a 12 unit, but it was 3 quads on 3 separate parcels. So theoretically, it could have been financed as 3 quadplexes, 3 different transactions. But in that case, the bank, I think, correctly identified it as a single property and said you really need to go with commercial financing on that, which was fine because that's kind of what we were intending anyway.
So the big thing is the value play. So let's just reiterate. You buy a property it has a valuation of $1 million, and you raise the rents up $100. And now it's worth $100,000 extra. That increases the value. That's the value add play, right? Let's define that a little bit more. A lot of people hear that. That's what people are looking for in multifamily. How could they add value? You add value, it creates phantom wealth, basically, right? The valuation goes up, then you can charge more and sell more and make money.
Yeah, that's right. So the simple thing is it's important to understand how cap rates work. So most of your really all of your commercial stuff is really valued based on cap rates, which is like a market measure that says what properties are selling for. And that relationship is, it's real easy to see on paper, but it's a little hard to explain on audio. But the basic relationship between a cap rate is the net operating income. Well, the value actually equals the net operating income divided by the market cap rate. So the important part to understand with that is that if you know any 2 of those 3 variables, either value, cap rate, or net operating income, you can calculate the third one. So you can kind of switch those variables around and use a little algebra and calculate each one. But what it amounts to is, if you had an example, say a property made $100,000 net operating income, we'll make the math real simple. Let's say that it was a market that the cap rate was a 10% cap rate. So you would just take the $100,000 net operating income, divide that by 10%, 0.10, and you'd come up with $1 million value. Where this is important is if you are able to raise the net operating income by, say, like $10,000, then you would divide $110,000 by 10%, because the cap rate would be the same in that scenario, and you'd have $1,100,000 property instead of $1 million property. And that's really what we're talking about. So if we can raise that net operating income, we can sort of magically create $100,000 in extra value. And the reason for that is the next person down the road is going to look at that property and say, shoot, it's making, $110,000 a year. I think the market would pay a 10% cap rate. So I'm willing to pay 10% cap rate to buy $110,000 a year income. And that's really what it is. It's almost like you're buying the stream of future cash flows, not the property itself. And that's how the sophisticated multifamily investors are, analyzing it. And because everyone's analyzing it that way, it sort of creates a situation where it's predictable how those are going to be valued.
Now, I know that everyone in the commercial world does use cap rates as an indicator, but how do you know what the right cap rate is for that market? For example, things are trading at 6% cap rate in Oklahoma City because there's no deals versus, 20 years ago, you can get a 10 cap rate, which is unheard of today, or depending on certain markets. I'm assuming in dissolute Detroit, cap rates are probably 8 to 12%.
Yeah, I mean, actually, we're seeing cap rates in the low sevens now in Detroit. And it's the same thing everywhere. There's less deals than there were, which is driving cap rates down, which is essentially, driving values up. What cap rates really are, though, is it's sort of like a stock price, right? I mean, it's a market measure of what the market as a whole values that property at. So as the market heats up, people are willing to pay higher and higher prices, which translates into lower and lower cap rates. And, you really can't predict what cap rates will be in the future. You just kind of have to assume the market knows what it's talking about. If everyone in that market is paying a 6 cap, like you're suggesting they are in Oklahoma City, then that's what the value is right now. It's possible that in the future it will go back to a 7 or 8 cap, but it's also possible it would go to a 4 or 5 cap like it has on the coasts of America. And cap rates are really what the return that the investor that's purchasing it wants to achieve. So, I mean, if you think about it from the other side, we were talking about, raising NOI, but if you think about what would you buy for $1 million, if you need to make a return of 6% on your $1 million purchase, that means that you're willing to pay a 6 cap. If you need to make a 10% return, you wouldn't be willing to buy that. If you're saying, hey, if I'm going to put $1 million in, I need to make $100,000, then you wouldn't be willing to buy, a 6 cap asset. And that's what the market does, right? Some people are willing to pay more. And right now, apparently in Oklahoma City, they're willing to pay 6% cap rates. And so that's, how you tell is just look at what the market's trading at and keep track of it. It's really mostly an average of all the previous sales in the market over a short period of time is the best way to tell.
So when you're investing in, let's just say 6% cap rate is what you're looking for, does the investor look at depreciation or auxiliary income like laundry, or is that all grouped in together in your cap rate, or is that something that you consider is depreciation value from there? And then there's a variable called taxes, but it's net operating, that's after all expenses.
Right. So net operating income doesn't account for depreciation and taxes because those things, it does account for property tax, but it doesn't account for the income tax because tax rates vary depending on the individual. Same with financing costs. They're going to vary from individual to individual. So your net operating income is really all of your rental income. It would include things like laundry income and other incomes, the late fees, vending income, whatever else you might have. And then take away all of your operating expenses, and your operating expenses are regular maintenance, not CapEx. So not like replacing roofs. It's just, the regular turn costs, the things like that. And then also you'd take out, all of your, if you have any staffing costs, if you have, obviously the property taxes, the lawn yard maintenance, things like that. So you take out all those expenses, but what you don't do is take out the stuff that can be different for different individuals. It's trying to come up with a fair market analysis of what the valuation of that property is.
So, but like you as a real estate investor buying multifamily homes, do you look at depreciation as an added value? Or is that just something that we don't even consider? Like I look at that as a residential investor because depending on how long I'm going to hold it and I can write off phantom income at the time to offset money that I'm making? Do people do that when they're doing multifamily? Do they consider the depreciation factor of it?
Yeah, definitely. You want to consider that. I mean, you're going to consider everything that you can, all the variables that you possibly can know. We build out an Excel model that sort of says, hey, here's what we think it's worth right now. Here's where we think it's going to go. So we're going to raise the income. We're going to cut some expenses here or there. And that's going to increase the NOI. It's going to increase the value. So that's one part of it. And that's sort of modeling the value. But the second side of that is modeling the tax consequences of that. And right now, under the current law in the United States, if you do a cost segregation study, you can take a tremendous amount of depreciation in the first year. But we recently bought a 32-unit apartment building where we paid about $1.5 million for it. And in that case, we were able to do a cost segregation study. And even though we only put, say, $400,000 down on that deal, we were able to take depreciation of almost $600,000 in the first year. So we're actually able to write off more than our down payment amount, and that eliminates income on other properties that you might have, or if you're a real estate professional, on any income that you might have.
Cool. What do you see right now? Since Donald Trump changed that accelerated depreciation. Which is that why the market's so hot right now in commercial?
Well, it's definitely not hurting the market, right? We had talked previously about market cycles, and we're kind of late in the market cycle. So, I mean, part of the reason the market's hot is just because where we are in the market cycle. I explained last time, I think we still have a little bit of room left on that. There's still definitely a lot of people coming into the market and saying, hey, rents have been going up, values have been going up, so it's a great time to buy. And certainly if rents continue to increase and values continue to increase through, cap rate compression like we've been seeing, then those people are going to do very, very well. But we're late in the cycle, so you have to consider that additional market risk. And in theory, that's built into your cap rate, right? If everyone knows the market's going to go down, then cap rates go up, because as soon as the market knows about something, it should be reflected in the prevailing cap rate. But that sort of efficient market theory is more an economic modeling theory than a reality in some cases. So you definitely need to be careful not to get burned by a change in the market.
And that's the funny thing. It's like, I get made fun of all the time. Another investor goes, hey man, stop paying 2011 prices. And because I've been an investor for 20 years, I'm assuming I'm not going to pay this much money per unit. But you really have to look at what you're making on the profit. I mean, what you're making on that machine. It's an ATM machine throwing off cash. How do you do in a calculation? In residential, I know if I put cash down, my cash on cash return, and I get it back in 5 years, that's a solid investment in my mind. 3 years is a home run. 4 years, I know what I'm doing. 5 years, I'll do that all day. That's a basic equation that I run as a residential investor. How about that in the commercial world? Because do you run numbers like that, like your gross revenue or the revenue? Say you paid all cash for that apartment building. You paid $1 million for that 32 unit that you have. How much is that throwing off? And do you do the calculation? When am I going to get all my money back?
Yeah, so I mean, the calculation is a bit more complicated when you have financing involved. And on that particular deal, we went into non-recourse financing, which means we're not personally liable for the loan balance. It's all supported by the property itself. So in that case, we're not really able to sell it necessarily, because there's some prepayment penalties and things like that. So in that case, we really did run the numbers kind of similar to what you're saying. We looked at how much we were putting down, and how much we thought it would generate in the first year and what we thought it would generate in the second. Because again, you're dealing with 32 units, you're going to have some turnover, you're going to have some rent changes. So we're modeling it out on what we think that we're going to make each year. And then we run a calculation to say, what's our cash on cash return in year 1, year 2, year 3. And you can do that as long as you want, but the further out you go, the less accurate your projections are going to be. So we kind of use a 5-year model where we look at what it's going to look like over the next 5 years, and then what if we were to sell it at the 5-year point, what we think we could sell it for. And what we typically do is assume that cap rates are going to go up about 0.5 point during any 5-year period. There's good economic reasons for that. It's mostly to do with the age of the building, honestly, more than anything else.
So you're telling me that you're getting a 6.5 cap rate today, and you're assuming within 5 years it's going to go to 7?
Yeah, I mean, essentially that's, and I see that a lot in like broker, pricing memorandums and things like that, where they're making that same kind of assumption. The economic theory behind that it has to do with functional and physical obsolescence, and basically the theory, sort of accepted real estate theory, is that cap rates should go up about on a particular project about 10 basis points or a tenth of a point every year. So if you were going to keep it for 10 years, you would assume it would go up a full point. The problem with that is that the further out you project it, the more subject you are to market risk. And one thing about markets is, and we've even seen this over the last, 10 years or so, yes, cap rates have changed over the last 10 years, but cap rates haven't changed that much from one year to the next, right? I mean, there's a cumulative effect. Cap rates have been going down, but they go down, a tenth of a point or a quarter of a point. And then the next year, they're about the same as they were the year before. And it goes down a little bit more. If you look at it over a 10-year period, yeah, cap rates went from 10 or 11 cap in a lot of markets down to 6 or 7 caps. And that's significant, but when it happens over 10 years, it's only a small amount each year.
Interesting. Now, every time we talk about multifamily in general, not just you personally, everyone's a positive, cap rates are going to go up, market's hot. Do these investors ever plan on failing? Meaning what happens if we do take a market turn and, you're enjoying a 6 cap rate, and then you get financing on this non-recourse loan, which seems to be pretty simple. And then it's flippantly saying that it's not easy. And then what if, it goes down to a cap rate of 4% and you just lose your shorts? Is there people think that far in advance, or is there a contingency plan to mitigate that? I mean,
there has to be, right? So for us, it's cash flow. I mean, honestly, if cap rates go down, we're celebrating, because that means the market's willing to pay more for the property, and we just sell it, right? So if it doesn't affect our individual property and it's just a market cap rate that's declining, then that's really good for us. So if we bought at a 6 cap and we could sell at a 4 cap, and we effectively made 50% increase in equity without doing anything, right? It's buy high, sell low. I don't think that's very likely. I think cap rates are more likely to go the other direction, which hurts us as an investor. But I mean, it's still a guessing game, right? The market only knows what the market knows, and I can't credibly say that I know anything that the market doesn't know. If the market thought cap rates should be 10%, then that's what they would be right now. And I think it's arrogant to think that I could know more than what the market does. So I try to just accept what the market says, and then look at, okay, now that I know what the current market cap rate is, what do I know that's appropriate to this particular property? And that's why you add that little bit. But the root of your question, I think, is what happens if your own income goes down? How do you protect against that, right? Because if you bought something and maybe you paid 5%, or 4.5% interest on the loan, and it's amortized over 30 years, and at a 6% return on your investment, you might, because of leverage, be making 7 or 8% cash on cash returns, which some people are very happy with. We try to do a little bit better than that. But if you were in that situation, and then you maybe your rents fell, or your expenses went up, or you just miscalculated something and you didn't realize what the true rents really were going to be, or whatever it was, and then you didn't make that 6% that you thought you were going to, and maybe only made 4%. Well, now your borrowing costs are exceeding your income, and that's a really big problem. And that's I think why banks are really, when they're underwriting these things, are really particular about things like debt service coverage ratios, which are simply, the amount of net operating income projected over the amount of the debt financing. So it's just a ratio. It's if you think you're going to make $100,000 a year and it's going to cost you $50,000 a year, let's say, for financing, then you have what's called a 2.0 debt coverage ratio, which would be really safe. If you were off by $25,000, you still were making $25,000 a year more than your financing costs. But on the other hand, if you're buying something at like a 1.1 debt coverage ratio where your loan costs were $50,000 a year, but your NOI was only $55,000 a year, if you're off by $10,000, you're in trouble, right? Like
Right.
now you're losing money every month, and that's the situation where you get into a big problem. And so we just try to underwrite super conservative margins, and we look at worst case scenario numbers and say, what if this happens? Then what does it look like? And if you do that, you can be relatively safe in multifamily. But I mean, it's like any investment. If you make a mistake, it can get brutal really fast.
So we're talking like we're sophisticated. Well, you're more of a sophisticated multifamily buyer, organizer, syndicator / how does the young person that, sees that you can scale real fast, all of a sudden you own 1,000 units relatively quickly, how do they get in the game of multifamily? Like, is there a gateway drug or a seminar? I see 1,000 of those everywhere. What's the gateway? What's the process for people that authentically really want to get into the real multifamily game?
I mean, they just call up Stephen VanCauwenbergh and have him tell them what the secret is, right? I think that's your coaching program, right? Like you just coach people to have 1,000 units in a week.
Just bring me $1 million and I'll coach you. Yeah,
right. That's right. No, you know what? There's no simple way. And I mean, there's a lot of people out there trying to sell seminars and stuff, but you and I both know that it takes a while to go from 0 to 1,000 units. It's not something that happens overnight, and neither of us have done that, as far as I know, unless you bought it like 800 units last week or something.
No,
that you tell me about.
I haven't, but I mean, a lot of people think there's such a big wall to get in, or they have to do the traditional way, which is like start with single family, maybe do some commercial, and it just seems like a logical decision. But I noticed that in the last 4 or 5 years, people are just waking up saying, I'm in multifamily. I'm going to do the very best I can. I'm going to learn the language, and I'm going to start mining deals, and then I'm going to get funding. Is that possible?
It is possible. I mean, I know people that have done it. I've taken a more conservative approach and taken a slower approach at it. But listen, if you find the right deals, and so if you educate yourself, you read the right books and you talk to the right people, maybe you associate yourself with someone who's already doing multifamily, and that might be investing in one of their deals as a limited partner just to sort of get exposure to it. It could be asking them what that you can do to help them and getting in on the general partnership side so that you're kind of tying into a network that's already there. You can move into multifamily that way. And that's where those conferences and things where they're specializing in multifamily can be really useful, because you get to meet a lot of people that are doing that kind of stuff. The networking side is going to be really the trick, I think, if you want to get in and you want to go fast. But I would still caution people about, trying to go too big, too fast. I think somebody told me once that if you bought one house and then the next time you bought a duplex and the next time you bought a fourplex, and then it wouldn't be that hard for you to think about buying an eightplex. You just kind of double up every time. And it just doesn't take that long to grow that way. And that's kind of what we did. We didn't double every time, but we just tried to buy a little bit bigger building every time we buy one. We started out with the 12 unit that I was saying earlier, then we bought a 19 and then a 32 and then a 41. And, it starts to add up pretty fast when you start doing that kind of stuff. And once you get that experience with a couple of them, then the banks are, working with you a little bit easier, and the underwriting becomes a little bit more straightforward because you've kind of had exposure to it and you kind of know what they're going to ask you for and when they're going to ask it. And you start to get the qualifications, like the non-recourse thing we were talking about earlier. If we didn't have some units already, or we didn't have a partner that had units already, we would not have been able to get a non-recourse loan. That's not something they just hand out. Like you alluded to, it's kind of tricky to get them. And in some cases, they might not be worth it, right? Especially on a 10, 12, 15 unit. If it were possible to get it, it might not even make sense.
Okay, you mentioned two things. You mentioned a limited partner and general partner. Some folks don't know what that means. Can you kind of elaborate on those and what's their purpose?
Sure. So limited partner and general partner, actually, they're the lawyer in me comes out and says that they're really not the accurate terms. It's what people use in the market now, but it comes from a time when we used to have a thing called a limited partnership, which was not how most of these deals are structured now. And the idea is that the limited partner is someone who just puts in money and that's it. They're not signing any bank notes. They're not taking any liability besides risking the money that they put in. So I might have a deal that's, let's just say I have a 100-unit apartment complex and I'm going to raise $2 million. I might say, hey, Steven, you want to invest in my deal, put up $100,000 and you can own, 5%, 10%, whatever it is, right? And you're acting as a limited partner there. You're just putting the money in, you're kind of trusting me to operate it. You're assuming that, you're going to get your return based on the projections that I'm promising you. But you're getting whatever percentage of the deal and whatever kind of complicated structure that deal might entail. So that's what a limited partner is. A general partner is really the other side of that equation. That's the person putting the deal together. It could be a person that's just signing on the notes. In some cases, I might be putting a deal together, but it might be, a $10 million loan. And the banks might say, we really want to see someone that has, $1 million in liquid capital to sign on this loan. So I have to bring a partner in because I don't have $1 million sitting in the bank, but maybe I know someone that does. And so that kind of person would also be a general partner because they'd be signing on the loan. They'd be participating in the operation of the property, and they're taking additional liability as a result of that.
Okay,
and
cool.
So that's really the difference between the two.
I love what you said. I mean, well said. That's why you're on the show, homie. Because I thought of it like this. A limited partner is passive. They're not really doing anything, and a general partner is active. And so they're the ones that are either putting the deal together. Maybe they're not actually physically doing it, but they're the KP, also known as the key principal, and they're signing their name, aka active, in the deal because they're not going to sign their name on a $10 million deal if it's dumb.
Right. Well, and even on a non-recourse loan, there's still technically some recourse. The non-recourse, I don't know if we clarified it. It just means that you're not personally liable for the loan balance and that the banks will go after the property, but not the individual investors. But the key principal is subject to something called a bad boy carve out, which basically says, if you loot the company, like if you take all the rents and don't pay the mortgage payment, you distribute all the rents to the investors or to yourself or whatever it might be without making adequate, payments to the mortgage, then that person can still be, it's sort of like the recourse comes back. They say it's non-recourse, but it's a limited version of non-recourse, meaning that there's theoretically a chance that they might be on the hook for it. So yeah, you definitely want to be careful. And it could be something like in your scenario, if this high net worth individual signs on a loan as a key principal, and then maybe I'm on the loan and I'm not a high net worth person and I do something wrong, they can still go after that key principal, right? Yeah. So it's because they signed on the loan. So that person really would need to be actively involved in it. And so you're definitely right. There's an active passive element, but the real difference is whether there's limited or, less limited liability.
So I've been to a few meetups or multifamily hangouts, or I don't know, been at some seminars, and I've heard the word thrown around a lot, waterfall. Explain what a waterfall is.
That's when water falls off the side of a mountain.
Yeah.
Oh, yeah, you weren't talking about that kind of waterfall. No, so
I'm talking about the people that put the deal together.
Yeah,
It's a Kilimanjaro.
Yeah. So listen, so waterfall is a sort of complicated deal term, and it can be almost anything. But basically, it's like it's also called an investor promote or an entrepreneurial promote. And basically, what they're doing is they're saying like maybe the limited partners are putting up 80% of the money, and the general partners are putting up 20% of the money, but and they're going to split everything 80-20 until a certain point. Like say when after the limited partners make a 10% return, anything after that is going to be a 50-50 split. So the general partners are being paid what's called a waterfall, which is to say that they're getting a higher amount after a certain thing happens, whatever that might be. It might be after an 8 or 10% return. It might be after, on sale, they get a higher percentage. It might be that after a certain internal rate of return is achieved, they get a higher percentage, but it's something like that where there's some kind of mechanism designed into the deal to pay the the sponsors a higher return than the limited partners, essentially to compensate them for the risk that they're taking in doing the deal and putting the deal together.
Cool. Well said. I like that simple approach. I love the way you break it down. All right. So let's wrap this up with another terminology that I hear a lot. Is called the syndicator, syndication, sponsor, lead investor. There's so many different terminologies. Break it down. What is a syndication and what is a syndicator?
Well, so a syndication is any time that two or more individuals join together in a joint enterprise with the intent of making profits. And so technically, any time where there's an uneven distribution of income between two groups, you're having a syndication. It doesn't even have to be in real estate. But in the real estate context, your syndicators, sponsors, are really the people that are on the general partner side. They're the people that when we were describing limited partnership and general partnerships, the general partners are putting the deals together, and they're creating this deal for the people that are going to invest in it passively. And that's really why they get compensated the way they do, with like waterfalls or maybe like a deal management fee or an acquisition fee, because they're doing some additional work that the other side's not doing. So you're getting paid for that work. And really what a syndication is in that context is it's those people that are on that syndication, the syndicator side, right? Are selling a security. They're selling shares in a company that owns the real estate. They're not actually selling real estate, right? So if I've got a deal and I'm selling you 100,000 of it, like we were talking about earlier, I'm really selling you $100,000 worth of shares in my company, in whatever rights that are entailed in those shares. It's just really important that if you are going to invest passively in someone's deal, that you're making sure they're complying with like the Securities and Exchange Commission rules. Or if you're putting together a deal, you really want to make sure you're complying with it, because there's a lot of liability associated with not following the rules. And that's a pretty advanced topic and probably beyond where we're at now. But generally, a syndication is when somebody puts together a deal and then other people invest in it.
Awesome. Jeff, I love your passion to help and educate people. How do people get a hold of you? I know you have a radio show, your own, or podcast, or YouTube channel, which is pretty phenomenal, just really laid back. And I was talking to someone the other day that follows you that I didn't think that would follow you. And he's trying to create a business name for himself. And he's like, I want something like old-fashioned real estate. And I just almost buckled over laughing. I don't know if he knew how much love I have for you, but he was trying to create a real estate name, and he's like, I want it to be it wasn't in real estate, it was in a totally different industry, but he wanted that vibe of old fashioned. I was like, well, okay.
Yeah. Right. Well, so, for people that don't know, the Old Fashioned Real Estate Show on YouTube is we drink the bourbon old fashions, like bourbon and simple syrup and bitters. So we drink one of those while talking about real estate. This is why it's a YouTube show and not like a podcast or something, because we feel like if we're going to drink on the show, people should be able to see it. And this is short little educational episodes. They're like 10 to 12 minutes, 15 sometimes 8. But basically just a short little episode where people can sit down, have a drink, and learn about whatever particular topic it might be that we're covering that week. And we've done some on syndications and things like that, and 1031 exchanges. So if people are interested, they could definitely go to youtube.com/oldfashionedrealestate and follow us and subscribe to our show there. They can go to oldfashionedrealestate.com. And we have, contact us stuff there as well. And then also my personal website, which is jeffreyholst.com. Right now that's under maintenance, so it's just directed right back to oldfashionedrealestate.com, but shortly the new site will be up and they can check that out as well.
All right. Well, Jeffrey, I'm honored to have you back on the show. And I know the next subject that we're going to discuss is 1031. How about that?
Yeah, we can do that.
And I'll see you next week or in a couple of weeks. Have a phenomenal summer.
All right. Yeah, you too, man. I hope to see you when you come to Chattanooga for the Savvy Boot Camp. That's going to be really fun.
I'm excited. See you there for sure.
All right. Later.
Bye.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter @LandlordBook and always be buying assets.